Appreciate it. We are going to talk about how to find a share that's right for you. It's like a dating show for shares and people. So it's exciting. So you can follow us on Instagram. We have a new post up from yesterday. We put up a new post. And you can, of course, listen to our podcast. So before we get started, a couple things. Number one, anything you hear today is general advice. I don't know anything about you. I can't offer personal advice. If you're in New Zealand, you can get a copy of our FAP from our website, morningstar.com.au. And the New Zealand regulatory authorities would encourage you to speak to a financial advisor if you would like personal advice. And I'm Mark LaMonica, and I'll be going through the webinar today. I look after the individual investor team for Morningstar here in Australia. So why don't we get into it? We do have a couple exciting things today. We have a poll. So we have started a poll. So we will put that up, and it'll allow you to test your knowledge from today, which is exciting. And we have a post-webinar questionnaire that if you're still around, it'd be great if you could fill that out, so we can try to improve these things for everyone. All right, let's go. So we are in the 6th of a 8 webinar run, how to find a share that's right for you. So once again, we started with all of your goals and portfolio construction and asset allocation. We moved on to starting to look at investments, looked at funds and ETFs. Now we're looking at shares. So last week we concentrated on valuation and then moat, how to find a great company. And today we're going to talk about some other metrics you can look at to try to find a share that fits your investment strategy, your goals. And yeah, hopefully it should be a good one. So ask any questions as you go through. All right. So how do you find an investment that is right for you? So as I said, last week we talked about what makes a good investment opportunity. So that's finding a great company at a compelling price. But there's a lot of underlying characteristics of different shares that we can use to see what's right for us. And there are 3 reasons why we do this. And, the overarching notion is that there are lots of different ways of investing successfully. So we hear about these all the time. And we hear that there are different proponents of them in certainly the professional investment industry that say you have to invest actively or passively or follow a growth strategy or whatever strategy they are proponents of. And I'm here to tell you that there are lots of ways that you can be a successful investor. But the most important thing to do is you need to stick to whatever investment strategy and approach that you are taking. You need to stick with it over the long term. And it is really important to find something that resonates with you. And the simple reason is that if something really resonates with you, if you believe in it, then you're more likely to stick with it. And stick with it all the ups and downs that occur in the market. So we're more of a down. If we look at the current occurrences, we are more down than up at this point. But in order to stick with something, it's important that it actually resonates with you and you believe in it. And there will be some strategies that do based on your temperament and history and personality, and some that don't. The second thing is, of course, we all have different goals. And that means that over our lifetime of investing, there are going to be different strategies that we should enact at different times during our life. So if you are approaching retirement, if you're 64 and going into retirement, your portfolio, not just from an asset allocation perspective, but also from an individual security perspective, is probably going to look different than if you're 25. So it's important to understand what are the different characteristics that investments can have, that shares can have, so you can figure out what may work for you during different stages of your life. And then finally, anytime that you are investing in shares or taking a more active strategy in ETFs, or funds, so whether it's an active asset allocation strategy, whether it's investing actively within those asset allocation buckets, you are trying to, quote unquote, beat the market. Right? You may be trying to achieve your goals, but you're also kind of trying to beat the market because you're choosing not to invest passively. So acknowledging that that's what you're doing, we do need to think about where your edge or your just competitive advantage over other investors comes from, right? Because the average investor, of course, is represented by that passive index. So we'll talk a little bit about that one as well. But those are the reasons why this is important. So let's quickly look at life stages. So that's sort of that second bullet point on that previous slide. So I just took a hypothetical situation. So you're saving $10,000 a year for retirement. You're starting at 22. You're in a 7% return over 43 years, and you retire at 65. So, when we look at the very long run, of course, we can see, okay, so we start with zero. We get to almost $2.5 million by starting that early and earning that 7% return. So that's sometimes how we look at investment journey holistically. But when we go back and look at different components, there are times where you, of course, are going to want to take different strategies. So if we sit there and we talk about being young, so you're 30, and I just put in here a couple different things, your portfolio value. So you've just broken through $100,000. You're still contributing this $10,000 a year. So at this point, you are contributing almost 10% of your total portfolio value every year, which is a higher amount than the impact of that return, that dollar impact of the return. Of course, you have a percent in time and a percent of the total value. So why is this important to look at? This is compounding. And it's important to understand this because some people get discouraged early on, and they get discouraged early on because they feel like they're not getting anywhere towards their goal, even though time is passing, right? In this case, 8 years passed, 18% of this 43-year goal, and you're only 4.14% there. But don't worry, you make up for it later in compounding. And what all of this means is it tells you where you need to focus, right? So in this case, you have lots of time, lots of human capital, so the ability to earn a lot of money. You have minimal financial capital at this point, but what this implies is that you need to focus on earning money, getting your salary up, getting your savings rate up, and going through this goal-setting process, and you don't care about volatility. So you get the point. I'm not going to go through each one of these, but I do think this is an interesting exercise to go through and understand. But let's go back to when you're 60. So now you're 5 years away from retirement. So you got $1.7 million. All of a sudden, you can see, and we can see the implications of this, that the amount that you're putting into, that you're saving every year, so you're saving the same dollar amount, but the amount that you're putting in is nothing. Meaning that when you have $1.7 million, I'm not saying don't save, but what I am saying is saving that $10,000 a year will have almost no impact on your portfolio. Whereas a 7% return, which is what you're trying to get over this long time period, is $120,000, right? So pretty important. And what that basically means is, okay, what do I have to worry about as an investor? Well, now I'm more worried about volatility, right? Because savings matter to me less because I have less time to save and it's less of an impact on that portfolio, but I really care about volatility. So these are just examples of, and we're taking the two barbell or the two ends of the spectrum here. These are just two examples of how you may be looking for different investments at different times in your life. So we're going to talk today about what are those characteristics. The other thing that we talked about, which I'll go through quickly, is edge. So once again, if you're investing in individual shares or you're taking an active approach to ETFs or funds, so both asset allocation and within that, whether you're picking an active manager or not, you are basically trying to beat the market. So when you talk about edge, if you are deciding that that's the approach you're going to take, then you should know, okay, what are the different sources of edge or competitive advantages that you have to try to beat that average? So we'll spend a second on this. So there are 4 sources of edge. Informational. So if you have unique information to other investors, then that can be a source of edge, right? If I just, know things that other people don't know about certain companies, that's a really good reason why I should invest in those companies. Now, this is basically called insider trading at the end of the day. So we don't really use that. We still talk about it as a source of edge, but not many people have that. So it certainly used to be more commonplace, not just the illegal side of things, but also before the internet, before a lot of the laws about fair disclosure of company information. This used to happen a little bit more. So if you were kind of an insider and you knew people, and if you lived in the right cities, then yes, this could be a source of edge. Now, largely illegal, illegal and has been eliminated through the internet and the ability to disseminate information to everyone at one time. Analytical. So in this case, you have the same information as everyone else, but you do a better job of analyzing it. So the decision-making process, so making decisions off of that information, you have an advantage. Behavioral. So basically it means that you make better investment decisions. So you're able to resist the fear and the greed that drives people across market cycles, and you're able to make rational, good investment decisions. You're able to forget what everyone else is saying and sit down and assess an investment for what it is. And then finally, structural. So structural basically means that some people, but mostly professional investors, have a lot of structural impediments to making good investment decisions. So it's an advantage that almost all of us have as individuals, that that investing is not our job. We do not have career risk. We're not worried about trying to get promoted. We're not worried about if we're a managed fund manager. We're not worried about inflows and outflows and how you have to manage that. You have to invest while getting a bunch of money potentially when you don't want it, or having to sell a bunch of things to support outflows when you don't want to do it. So you don't have any of those problems. So structural is a real advantage. So once again, the reason we're looking at all of these is as we go through the different characteristics of securities, we can start thinking where, and I'll hopefully guide you through it, where those pieces of edge may apply. All right, so let's get into some different characteristics. So what I want to do, and they're not all purely factors, but what I want to do is I want to spend some time outside of valuation and outside of pure economic moat, the two things that we talked about last time, and say, okay, what are some other underlying characteristics of companies? And really, when we're going to assess these, we're going to assess them all in terms of risk. So once again, risk in the investment industry is measured through volatility. And we'll look explicitly at volatility as well later on. But we want to put all of this within the context of volatility. And there's a lot of reasons investors may or may not care about volatility. So certainly that example, as you get older and you're approaching retirement, you should care more about volatility. All right, so let's look at a couple of things around financial strength. So there are factors out there that are called quality factors. And you can, in fact, go out there and actually buy factor-based indexes that are based on quality, for example. And one of the big things when we're talking about the quality of a company is its financial strength. And if we think about, and we have a rating at Morningstar called the uncertainty rating that really takes a lot of what we're talking about today and encompasses it in one rating. Basically, if we think back to last week, remember that we are trying to figure out, if we're analyzing a company, we're trying to figure out what's going to happen in the future. And of course, that is impossible. So we're taking an educated guess. But that educated guess and the degree of certainty we have in that guess is going to vary based on a lot of different factors. And financial strength is one of them, right? So I can make an educated guess about what I'm doing tonight because I have plans. Now, anything could happen, but I can make an educated guess about what I'm going to do tonight, which is in the future. It's a lot harder for me to do it 10 years from now. It'd be a lot harder for me if I had no control over basically what activities I do outside of work. So let's think of some of these within that context of uncertainty. So if you have financial strength, it lowers the uncertainty, makes the future more certain because it's removing a very specific risk of a company. And to the extreme, that risk is, of course, a company goes out of business. So there are all sorts of factors that go into a company going out of business, but basically it's just because they can't pay their bills anymore. So we should assess the financial strength of the company. The stronger a company is, of course, the easier it is for them to respond to overall adverse financial conditions in the overall economy or company-specific ones. So the example that I always use, because I think it hopefully resonates with people, is Virgin and Qantas. So we go into a situation in 2020 that nobody thought was going to happen. Once again, except for Bill Gates, nobody thought was going to happen. And we had two airlines that are basically doing the exact same thing. And one went out of business and one didn't. Why was that? Well, Virgin went into this unknowable situation that had nothing really to do with airlines, right? Nothing to do with their operations, nothing to do with anything they were doing, just the fact that air travel got shut down. So they went into this with a significantly worse financial situation, and they declared bankruptcy. So this is why we are talking about the certainty or the uncertainty being increased if you are in poor financial condition. So what are some things you can do to look for that? So first thing is a credit rating. So credit rating, of course, is a rating that is determined by a number of different independent credit rating agencies. And really, it's just assessing a company's ability to pay you back. So that if I'm someone who's going to go out there and buy a bond, I can look at that credit rating. And that, to me, can make me understand whether they're going to pay me back or not. So it's the first place we can look. And it has a lot of other implications on a company as well that are reflected within once again, sort of that uncertainty going forward. So number one, it means that companies can borrow cheaper. So another thing that, of course, happens is if interest rates go up a lot, right, it will have less of effect on my business operations if I can borrow cheaper, if I have a stronger credit rating. And the other big thing is it's access to debt. So there are companies that have such poor credit quality that they cannot use the debt markets to raise funding. And that, of course, removes options. It makes them riskier in terms of going out of business. So in terms of credit rating, really something you just probably have to Google. So go and see what anytime somebody issues a bond, anytime a company issues a bond, they will get a credit rating on that bond, which will be their overall credit rating. So just Google it. You can find credit rating as long as they have publicly traded debt. The other thing you can look at is the debt to equity ratio. And the credit rating will really take a lot of different things into effect. But there's the debt to equity ratio. So it's something you can see I put in how to actually calculate it. But this is something, of course, that is available on lots of websites, including our own. But what this is really looking for, and there is no good or bad debt to equity ratio. So I'll start with that. So many of these different things that we're going to talk about, these characteristics, have to be compared within companies within the same industry. Similar types of companies, basically, at the end of the day. And I'll give an example of that in a second. But yeah, what we're basically looking at here is, a company with a lot of debt will have a high debt to equity ratio. Small amount of debt will have a low one. So why do we have to look at just within that industry? Is because industries are different. And there are certain characteristics of companies that will support higher debt levels. And generally what that is the certainty of their cash flows going forward. So if we are a company that has contractually, like we always see it through infrastructure, generally is really high debt to equity ratios. Real estate, so real estate investment trusts, they generally have high debt to equity ratios. So I'm just saying that when you compare those, don't take an infrastructure company and compare it to a tech company. So compare within that industry. But it does give you an apples to apples comparison if you're looking at two different companies within the same industry, for example. The interest coverage ratio. So, of course, you need to pay your interest back on the debt that you have from either a bank or from a bond. So what do we look at here? Well, we simply look at earnings before interest and taxes, and we compare it to how much they pay in interest. And what we're hoping for here is obviously multiples. If you are in a very low interest coverage ratio, probably not great. And what we're trying to look for here is just financial flexibility from a company, right? So the higher that is, the higher they're able to cover their interest costs with their earnings before interest and taxes, the higher that is, the more financial flexibility they have. Means they could start earning a lot less and they could still cover that interest coverage ratio, so they wouldn't go bankrupt. It means they have the flexibility to do all the things that you want them to do as a company, and paying back debt, while necessary, is not a great thing. We want them to reinvest in the business and grow the business. We want them to pay us dividends, want them to buy back shares. Gives them a lot more flexibility. So if we think about this in sort of a personal standpoint, is, we have these for mortgage payments as well. How much does your salary cover the interest and principal in that case that you're paying off in your mortgages? The more flexibility you have, the more fun you can have in life. If almost all of your salary is going to paying off your mortgage, then hey, you could be in trouble if you lose your job. You won't have the flexibility to do fun stuff, which for a company is reinvesting in the business and giving us dividends. The other thing to look at, if the company is heavily indebted and you're getting a little bit worried about maybe their credit rating, it's to do a check of the maturity schedule of debt. Now, you can get this by looking in the financial statements. So you got to do a little digging. This isn't something that you're generally going to find on a website, or analysts may talk about it if it's something they're concerned about. But very simply, if you have a lot of debt due and a lot of it's due very soon, and you have other signs that you're potentially in distress, this is a very bad thing. Because chances are you are going to have to pay back that debt. And you're going to have to roll that debt over, most likely, right? So you're going to have to go out and borrow more money. So one bond matures, you're going to go out and try to issue another bond. Or if you've got a terrible credit rating because you have a ton of debt, really high debt to equity ratio, you're barely able to cover it with your earnings, then it's going to be harder to raise more money. It's certainly going to be harder to do it at any sort of, cheap interest rate. So looking at the maturity schedule of debt, what we'd like to see, especially if the company's in trouble, so we'd like to see all their bonds maturing way out in the future, because at least that gives them time to try to clean things up. So just a couple things you can look at. There is a link. So Chanika says, this is interesting. So thank you for that. So somebody could drop that link into the chat, just the YouTube link. That would be great. So Lisa's saying, are these factors generally revealed in company annual reports? So some of them are. So what I would say is, so thank you, Lisa, by the way. So what I would say is the maturity schedule, debt, generally be in that annual report. Debt to equity and interest coverage ratio are calculated ratios, so they may or may not be in there, but you can get them off of almost any financial news website. Credit rating would generally be somewhere in the annual report, but you could also just Google it. It's generally just publicly available. So yeah. All right. So let's talk about operating performance. So operating performance, we talked a little bit about this last week, but think about what a strong company is. So a strong company uses the assets that company has, and they use them to grow sales and earnings, right? That's what you want out of your company. You want them to prudently and profitably invest the assets they have, like cash, use the assets they have, like buildings or any other tangible assets they have, and that's the sign of a really good company. And being able to generate returns above, and we talked about this last week, above the cost of capital is, over the long term, a really good thing for investors. So very simply, it means I can go borrow at 5% and invest and earn a 10% return. That's a really good thing for me as a company, right? If I'm going out there, and we'll go through a couple of examples, if I'm going out there and borrowing $1 and earning $1 return, that's not great, right? It means that ultimately I am, I guess, breaking even in one sense of the word. It means I can still grow, but it's not, profitable growth that's going to accrue to me as a shareholder. So we hear all the time how fast these companies are growing, all right? But it's important to look at, are they growing in a way that eventually is going to benefit me as a shareholder? And that means that whatever's funding that growth, they need to be investing that at a higher rate than what they're paying for it. So something to think about. Let's go through a couple of these indicators. All right, return on invested capital. And a lot of these are the same. They're looking at similar things. There's some nuances, but just remember, these are important things. So return on invested capital is what we talked about last week. So basically what it says is that, what is the company generating off of its capital base, right? It goes out there and gets capital from shareholders, gets capital from debt that it borrows. What is it earning returns on that? So the better the company, the more profit it generates as a percentage of its invested capital. So this will be expressed in a percent. We want high. And what we particularly want is we want a return on invested capital that is above the cost of capital. Now, cost of capital, as we talked about last week, is something that involves a little bit of estimates. It involves some study and some nuance. But think about this from a practical standpoint. If the return on invested capital is 7, that's probably not great, right? Because if you sit there and think about what they borrow money for, what their cost of equity is, 7, you're probably below your weighted average cost of capital. You start getting into the, teens at this point, given interest rate levels, the teens and up, that's a very good thing. So think about that for return on invested capital. And I did, of course, I'm going to get the exact number wrong. So maybe I won't say it, but I was looking at, I got asked, I was on this podcast that I was taking last week, and I got asked, what's a great company? And, to annoy the ESG crowd, I said Philip Morris, cigarette manufacturer. So whatever you think about smoking, they're a great company. You look at their return on invested capital, it's like through the moon. So it's like higher than Microsoft's. And that just indicates that they are able to take that capital they have and invest it prudently. All right. So return on equity. So return on equity is, similar, I would say. Once again, it's looking at the operating performance of a company. And so it's how much profit a company generates on the money shareholders have invested in the firm. So this is talking about you if you're a shareholder. So in the example, a 37% return on equity, that means every dollar that we make, the company produce 37 cents worth of profit. So that's good. All right. This is the situation where you don't want them to just be investing $1 and getting $1 back. Right. So we want that to be higher than 1. So return on equity is another thing you can look at. There's all sorts of different versions of these, and different investors, and you can find one yourself. Different investors like different ones. Like in Morningstar, we really like return on invested capital. But as long as you understand what that ratio is, they're all kind of saying the same thing. Like, how good is management at using what they have to produce good things for investors? Then, of course, we have the margins. So you read the different definitions we have on here, and depending upon the company, you may want to look at a different margin based on where the company is in the growth cycle, right? So an example is if we look at gross margin. So gross margin is very simply, I'm selling a good or service. It costs something to produce, right? I want to take a can of Coke. I want to produce a can of Coke. It costs me $1 to make this can of Coke. How much am I selling it for? So very strictly looking at that cost of the good or service that you're creating and what you're selling it for. So why would you want to look at this? You'd want to look at this if the company was, well, you could look at any company, but particularly if a company is earlier in its life cycle. And the reason you want to do this is think about a startup, right? Think about how a startup works. And this will be an extreme, obviously, but when you're a new company, you are still trying to get all that infrastructure in place. You're probably spending a lot of money to produce the product, or not produce the product. You're probably spending a lot of money on like research and development. You're still putting all the infrastructure in place. You've got to hire a bunch of people as you start to grow. You got to hire HR, you got to hire, all the sort of corporate services that you need. So in that case, your profitability, you could still be negative, right? You can still be losing money. But if you've got this really high gross margin, you're at least saying that the good that I'm producing, I am selling it for a lot more than it costs to produce. So now what I need to do is scale my business. So that's a really good thing. And I think some people get caught up looking at whether a company's profitable or not when it's early. And that's not a great place to look, right? Because it could be the greatest business ever. It's just got to overcome building out this sort of infrastructure of running a company. And at a certain point, the thing could scale. So that's why you look at gross margin. If you're looking at a more mature company, then you probably start looking at net margin or operating margin, depending upon the company. So these are going further down. If we think about an income statement, we start with revenue going further down. So net margin, of course, is the bottom line. What is the company made or not made? Operating margin, we're really looking at, in this case, okay, what are all the variable costs of production that we're not capturing, just like what does that widget cost to make? So all three are important things. We're looking for higher margins. And in a really good company, what we're looking for margins that are growing over time. Because what that indicates is that the company is scalable. So if we think about sort of the perfect company, and this is why these tech companies, our investors love them so much. So, the simple example is, if we look at Microsoft, and I know that their business has diversified, but we look at the very simple core thing that Microsoft does. What do? They build software, create software, and then sell it. And to create software, you just have to hire a bunch of smart people, right? You don't need a factory. You don't need any of that stuff. You just need to hire some smart people. So if those smart people, if it costs $1 million to create the next version of Excel, and obviously I'm exaggeratingly low what that was, it costs $1 million to create the next version of Excel. I could sell it to 10,000 people. I could sell it to 5 million people. That cost isn't going to change, and there's not going to be much variable cost. So that's a company that scales. As they sell more, to expand that revenue, their costs don't go up as much. So your margin over time goes up. So that's what we're looking for in terms of operating performance. So all of these, of course, can be indicators that you have a moat. So we talked about last week, and also indicators that, once again, the uncertainty of the future cash flows gets lower, because if you have a high fixed base, a low margin, right? If you have a low margin, high volume business, it doesn't take much for you to stop making money. It doesn't take much in a drop in sales if you've got these really high fixed costs. All these can be indicators. And then, of course, how profitably you can invest your capital is really important as well. All right. Sorry, just checking. Oh, there we go. Thank you, Shani, for sending through the YouTube. So the YouTube for all the previous ones is in our chat function if you want it. Shani is struggling with her puppy right now because he is wearing the cone of shame. He was on here earlier and we were looking at him. It was very sad. All right, so we're going to look at sectors. So first of all, what is a sector? So sectors are basically just a framework that we use to classify not like-minded companies that have similar characteristics. So, a sector is basic materials, and that has the miners, it's real estate, You get the picture. Technology. And the reason we want to do this and the reason we classify all companies within this set framework is because these companies have similar characteristics, which means that they will perform. And we're talking performance. We're not talking about the stock price right now, although it's tied, and we'll get to that in a second. Perform just as a company differently during different parts of the economic cycle. So what we generally do is this is a framework. Everyone does this. We put them into sectors that are cyclical, defensive, and sensitive. And those sector classifications, those grouping of sectors, indicate how they will perform at different times during the business cycle. So some companies perform really well when the business cycle is ramping up. So when we're starting to do really well economically, they do really well. And then if there's a recession, they do terribly. It's the nature of the goods that they're selling, the goods and services that they're selling. Some companies just stay the same, generally, no matter what the economic environment is. So let's use some examples. So let's start with cyclical. So these are the ones that are highly sensitive to where we are in the business cycle. And generally what investors will do, some investors will, of course, try to catch all of these different cyclical, sort of cycles and how different companies will perform. Now, remember, when we invest, we are anticipating the future. So you can't wait until everyone knows that you're in a recession to make a move in your portfolio. You have to do it before, when nobody knows there's a recession coming yet, or very few people know. But cyclical sectors, but besides trying to time the business cycle, which I wouldn't recommend because that's very hard, besides that, it lets you as an investor understand the characteristics of this company. So cyclical sectors, highly sensitive. So we've got basic materials, consumer cyclical, financial services, real estate. I'll use a couple examples. So basic materials, as I said, are the miners. What do miners do? Generally, they are mining things that go into construction. All right. Iron ore, classic example, because we're in Australia. What do you do with iron ore? You make steel. What do you do with steel? You put it into a building or a road or a train track or whatever you're going to do with it. And generally, construction picks up significantly when the economy is doing well. And then construction will slow down significantly when the economy is not doing well. So that's an example. Then we've got defensive. So defensive sectors are things that aren't going to change much. They basically have very little sensitivity to the business cycle at all. So consumer, defensive, healthcare, utility. So all three of these, what do you think? Well, you're going to spend money on them no matter what, right? Utilities, you're probably going to pay your power bill no matter what's happening in the economy, unless you're in a lot of trouble. Healthcare, you're probably going to go to the doctor and get that operation, or go out and keep taking your prescription, no matter what's happening. Consumer defensive, you got to eat, right? You've got some basic needs that you are not going to adjust if the economy is going up and down. And then we have sort of the middle. So sensitive sectors, they have some correlation with the business cycle. So what does this mean as an investor? What it means is, once again, the uncertainty level of future cash flows goes up the more exposure you have to the business cycle. So I can reasonably sit there, and anything could happen, but if I'm forecasting out what Coca-Cola is going to make over the next couple of years, I can sit there and say, okay, it could go up a little bit or it could go down a little bit, but I don't really see the economic cycle getting to a part where nobody's going to buy a Coke. Because it's a consumer defensive drug. Same thing with the pharmaceutical, right? That if they're making a drug to treat, this group of diseases, chances are people are not going to go out there and stop taking whatever their prescription is because the economy is not doing well. So in all of those cases, you have more certainty of cash flows. There's still other things that can influence it, company-specific things, but you have more certainty if you're in a defensive sector. Because once again, the economy and changes in the economy that you can't foresee and you don't know are going to happen are not really going to be a giant driver. So if you're looking to minimize volatility, if you're looking to, so once again, just because these companies' fortunes go up and down during these business cycles, generally the shares will dance around a lot too. right? So, we sort of sit there and look at some of these cyclical sectors, right? Like look at what's happened with the iron ore price, which has impacted iron ore producers. So it went really, really high and then it's come down a lot and it's gone up a little bit again. So like that is something you don't have to worry about if you're Coca-Cola, just making Coke. There are other things to worry about, but not that. So more defensive sectors, lower uncertainty of future cash flows, generally less volatile. All right, size. So market capitalization is how we represent the size of a company. So it's just multiplying the number of shares that are out there by the price of the shares. So bigger companies, biggest in the world, Apple, it's the most valuable company in the world. Doesn't mean it has the most employees, doesn't mean it has the most revenue or anything like that. It just means it's worth the most. But the size of the company is can have a pretty big impact on long-term returns and also, once again, volatility and risk. So very simply, if you are a large company, you have a lot of advantages. So generally, large companies have better finances. I heard an interesting take actually on Tesla today while I was walking into work, just talking about how, at the end of the day, the share price doing so well potentially saved the company from bankruptcy. Because if you think back a couple of years ago, they didn't have enough money. They didn't have enough money to build their, battery factories or their car factories. Despite everyone sitting there saying Tesla is a technology company, like it is in a very capital intensive industry. Building cars is hard. Building cars involves lots of raw materials, involves lots of big factories, involves moving a bunch of stuff around. Building cars is an old school industrial company, no matter how modern the car is or what kind of batteries go into it. They are not a technology company. They are a company that uses technology, which is every company in the world. But anyway, my little rant about Tesla aside, that, they were potentially going to run out of money. And then the share price took off and they sold a bunch of shares. And they raised a bunch of money and they got to build a bunch more factories and it really helped the company. So being a large company has its advantages. You have more financial flexibility. You generally, maybe not in Tesla's case, but you generally have a more established business model. You have a proven business model. You have potentially a wider geographic area that you're operating in. All of this lowers uncertainty. But conversely, and we'll talk about this in a second, it also makes it really hard to grow if you're a really large company. It makes it hard to grow and makes it hard to grow fast because any potential investment opportunities that you have as a company aren't going to move the needle much, right? So if you're Apple and you sit there and you look at all these iPhones you are selling. So it used to be Apple was this company where they came up with this great new idea. And then all of a sudden that idea took off, right? So it originally happened with the iPad or the iPod. And then of course it happened with the iPhone. They were able to move the needle a lot because they were a small company then. They were selling some Mac computers, but they invented the iPod and they took off, right? That's what you can do as a small company. One idea can change the game. A lot harder for them now. So for them to invent a product, come up with a new product that was going to meaningfully contribute to their revenue is a very difficult thing. So big companies, it's harder to move that needle. It's harder to grow quickly, but there is more certainty about your future cash flows, right? So they generally have a lower uncertainty rating from Morningstar. Generally, they would be less volatile because they have the resources to deal with issues that come up. If one of their products doesn't do great, they have a bunch of other products. If there's a recession in one country that they operate in, they have a bunch of other countries that they operate in. Think of that versus a small cap company, smallest company where you are not as financially secure. I mean, you can't weather different economic events. You might only sell one product. Something goes wrong with that product, you're in trouble. You might operate in a very small geographic area. So if there's a big recession wherever you're operating, you could be in trouble. So small caps they're higher risk, they're more volatile. It's easier for a small company to go out of business. Now, one thing to think about is over time, there's this famous theory in investing. Well, I guess this was a data-driven observation called this three-factor model. And one of the factors that Pham and French, two professors at the University of Chicago, were looking at was, do small caps outperform large caps? And their answer was yes. Over time, small companies outperform. Then the GFC happened, and then large cap companies outperformed significantly since then. So it's kind of gone away, but doesn't mean it's not going to come back. So more recently, large caps have done better, but traditionally small caps did better. Traditionally, small caps are more cyclical, so they generally do better as we're coming out of a recession. Once again, they're more nimble. There's lots of things they can do. They generally do worse as we're going into a recession. So where you invest, we talk about asset allocation at a high level, equities, but where you invest matters in terms of size of companies when we think about volatility and the uncertainty of those future cash flows, which are tied. The other thing I would say when we get back to that behavioral element, that of course, if we go back to those sources of edge, if we look at analytical edge, so the ability to take data and interpret it in a better way than other people, that's a lot easier to do in general in small caps because less people are looking at it. There's less analysts looking at it. Less investors are investing there. So the smaller you get from a company perspective, the more opportunities you may have to, quote unquote, beat the market if that's what you're looking for. All right. So Lisa's asking, Lisa, you're winning the most questions today. I mean, you were winning before at 1 versus 0. Now you're up 2-0. So Lisa's saying, is it true that mid caps can often have the highest growth rate? So mid caps, and then just thinking about mid caps. So mid caps you kind of get, and I didn't talk about them, are kind of the best of both worlds in a little bit of a way, right? So it's sort of a middle ground where they still have the opportunity to grow quickly. They probably have more established financing, so more access to capital markets. So yeah, potentially it's a really good place to be if you're looking for the potential to still grow and a little more safety. So yeah, no, that was a good comment, Lisa. All right, so I had to throw this one in here because somebody would ask about it. So we'll talk about momentum. So momentum at the end of the day is a factor that has worked very well, once again, kind of since the GFC until whatever started happening last year. And basically what it's saying is that if a security price is doing really well, now this has nothing to do with the company, so I did not really want to put that in here, but I, decided to throw it in there for popularity's sake. It basically means that if a share price is doing really well, it will continue to do well. So that's sort of what a momentum investor is betting on. So I don't have much good to say about it, but except for the fact that it's worked well. A couple of different things you can look at is trend lines. So this is technical analysis at the end of the day, which I personally think is a little bit ridiculous. But that basically means that you are looking at a chart, and that chart is supposed to indicate, so looking at how the share has performed, that chart is supposed to indicate how it's going to do in the future. So for people that believe in that type of thing, they really believe in that. They're probably all the ones logging off right now. It seemingly has gotten more popular lately, but maybe that's just because everything's gone up for 10 years. But yeah, so that's trend lines. And then price and volume indicators. So what you're looking for is strong price growth. Once again, none of this has to do with the fundamentals of the company, and volume. So high volume, right? So high volume is how many shares are traded. So as volume increases, more and more people are interested in trading the stock. So if you have high volume and a significant price move, either up or down, means there's a lot of conviction that that share price should either go up or down, right? So high volume and a rising price means that there's a lot of investors that think this is a really good share to be in. And the thought is, of course, that this will continue. The only thing that I would add about momentum is, one of the huge factors that obviously influences investment markets are us and what we do. Sort of this herd mentality. People herd up and people herd down too. It's sort of this fear and greed, which spreads, right? So you go and you look at why people invest in managed funds, how they pick the managed fund they're going to invest in, or the ETF, or the share. What is one of the largest factors? How well it's done. So a lot of people think that investment research means I go on once a year, I check and see which funds did well, and then I move all my money into it. And then I don't check again for another year, see what did well, move all my money. Now, we know this doesn't work, right? There is reversion to the mean. But anyway, so a lot of people invest. So there is that side to it. Look, we got a question that was not from Lisa. So Lisa, you're in trouble. If Simon asks another question, you are out of first place. All right. So, it's not a question on today's content, but does a passive index ETF generally hold interest in other ETFs in the index? VAS is 51st on the ASX. So other ASX, no. So generally they do not. So basically, we're looking at two different things. So, ETF is following an index. The index is, of course, put together by the index holder. So like things that trade on the ASX, right? ETFs trade on the ASX, but no matter how much they trade on these on the ASX, they're generally not involved in another ETF. There are some exceptions. So exceptions are, there are sort of ETFs that have ETFs so you can get global exposure, right? So you might see a situation where I think Vanguard does this with a couple products where they'll say, okay, if you want to get total global equity exposure, come buy our product, single trade, just come get our product, and that product will hold other products. So, and don't quote me on what's actually in these things, but you might get a Vanguard Global Index that has a US ETF and a European ETF. So they might construct products that way, but most ETFs don't have that. That I answered your question. All right. So finally, volatility. So volatility, of course, is what a lot of these other factors have been talking about, but I want to just spend a minute, and we've done this before, on actual volatility. So volatility, of course, is how much a investment or your portfolio bounce around in price or value. So just want to throw a couple things out here that can give you an indicator of how much a share price is going to bounce around. So you can look at sort of the fundamental factors that we talked about earlier. Large caps generally bounce around less than small caps. Defensive shares generally bounce around less than cyclical shares, things like that. But you can also just go back and look at statistical measures. So beta. So beta is a measure of market risk. So a couple of things to think about with beta. So number one, beta compares a security or a portfolio to a specific index. So just be careful of that because make sure you know what index it's looking at. So, right, there are indexes that are more volatile. The NASDAQ is generally more volatile than the S&P 500. So just remember it's comparing it to an index. But basically what beta does is it measures how that investment return, that particular, if you want to take a share, take Microsoft, how Microsoft has performed in relation to the NASDAQ, for example. Then we can look at that beta or the S&P 500 or anything else. So a beta of 1 means historically, remember all this is historic measures. Historically, Microsoft has bounced around the exact same as the index. So you would expect the index goes up 10%, Microsoft goes up 10%. Now, this is all things being equal, and it's measured over a long period of time. Remember, Microsoft come out with earnings and go up a lot higher or a lot lower, depending upon them and other stuff. But over time, it's generally moved at the same level as the index. A beta below 1 indicates it will move less. And we see this all the time, right? So if we see really, really high returns, there'll be some shares that won't go up as much, right? The S&P 500 goes up 10%. A defensive share, Colgate-Palmolive, so we can pick a new example, probably won't go up that much. So you can see beta. So below 1 indicates it's going to move less than the market. Above 1, more than the market. We're literally looking at the percentage there. So 1.1 means that you would expect it to move 10% more than the market. So yeah, goes up 10%, we would expect it to go, the market goes up 10%, we'd expect it to go up 10% more than that, 11%, and same thing on the way down. So that's beta. The other thing is standard deviation. So that's measuring the dispersion of a investment's returns or a portfolio returns compared to its average. So if we have very high standard deviation, that means we could see lots of volatility, right? If the average is 10 and the standard deviation is 10, that means, we could see within one standard deviation or 66% of the time, we could see this thing going up 20% one year, 0 the next year. So we're just looking at, that dispersion around the average, because we always look at averages over long term in investing, but volatility is what happens in between. All right. So in that first example, we said a 7% average return over 43 years. That's great. There are going to be some years that portfolio is going to go down 30%. There's going to be some years it's going to go up 40%. So why do we care? Well, if we're looking for lower volatility, because we're approaching retirement, we can find shares that have lower volatility. If we are worried about behavioral risk, if we're worried that we're going to do something stupid if our portfolio falls too much, we might want to lower that standard deviation. So just some things to think about. Sharadi's saying a lot of multi-asset ETFs are holders of a number of underlying ETFs. Yeah, so that's that Vanguard example, but I think he was emphasizing a lot. And once again, we are going to get Rodney in here so that he can do these. Okay, so we're going to take a quiz now, which is exciting. So this is a new feature. Let's see if it works. All right, so I put out a poll. So you can answer the questions and we'll see how they work. So we're trying this new. I probably screwed it up. But if you see a poll, you should guess on an answer. So not guess, you should know. So strong credit rating. We'll go through the first question. Strong credit rating indicates the following about a company. Company have lower borrowing costs. Independent credit rating agencies, the company is a strong enough financial position to pay back its debts. The company continue to access debt markets to borrow money, or all of the above. So see if you can answer some of these. Then we've got a question around large cap and small cap companies. We just talked about this, so hopefully you picked up on that. We seem to be having 0 votes, so I don't know if the poll is actually working. It's supposed to be showing. But anyway, somebody voted for something. All right, cyclicality and a standard deviation. So anyway, go through and see if you can answer some questions. And in the meantime, I will sum things up and we'll finish on time for once. So a couple things. Hopefully what you got out of today is there are a lot of different characteristics and a lot of different metrics that you can look at for certain companies to figure out what is the investment that is right for you. And remember, all of us are comfortable with different things. So personally, I am generally comfortable with things that pay higher dividends, that have lower volatility, generally sort of in that defensive sector. It's just what makes me feel more comfortable. I generally seem to be pretty skeptical about things and how different companies are performing. So that's what I think is right for me. But figure out what's right for you. Figure out the different times in your life, what might actually be right for you. Because remember, we are just inundated with choice as investors. And one of the really good things about coming up with criteria is it gets to eliminate some of this choice and lets us zero in on investments that we actually want to spend some time researching and understanding. So next Tuesday, we'll be back with the 7th out of 8th, and we're going to talk a little bit about how to make sure you are still on track to achieve your goals. And then we will have, so everybody's working, just slow at answering questions. Yeah, I'll end the poll in a second. And then we'll have our 8th and final one. We'll talk about transition to retirement, which I think is a good one. So I'm going to end the poll now. Thank you for participating in the poll. So I will share the results so you can see them. And I will be back on Thursday if anyone's interested. So Thursday at 1 p.m. For the next webinar, we'll look at our ETF model portfolios, which will hopefully be interesting. And if anyone has any questions in the meantime, please email me at mark.lamonica1@morningstar.com. And as I end this, there will be a survey that comes up. So hopefully if you can spend 30 seconds answering those questions, I would appreciate it. Anyway, thank you guys for joining.